I'm sure you've seen tons of videos online saying things like, "This ETF will make you rich," or "You only need these 3 ETFs." Yeah, ETFs are super popular right now. But here's the thing. Almost nobody talks about the mistakes most people make when investing in ETFs, and those mistakes can quietly cost you a lot of money over the long term. In today's video, we're going to break down hidden fees, misleading performance charts, volatility, and even the real risks behind certain types of ETFs that are being recommended everywhere without proper explanation. So if you truly want to invest wisely, avoid losing money, and actually make your ETFs work for you, stick around until the end of the video. Welcome to Martic Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. Mistake number 1, assuming an ETF is well diversified without checking what's inside. Most people think that ETFs are always diversified. And yes, for the most part, ETFs are more diversified than buying a single stock. However, sometimes some ETFs can be much more diversified than others, and understanding this difference can be a crucial factor when choosing where to invest. And the best way to do that is by checking the holdings in the ETF fact sheet, which tells you how many companies the ETF holds, what sectors they belong to, and how much of the ETF is concentrated in the top holdings. To make this clear, let's compare 2 different ETFs, both focused on the healthcare sector. First, we have XLV. The Healthcare Select Sector SPDR fund holds about 65 companies. Sounds good, right? But most of these are large established companies. Think Johnson & Johnson, Pfizer, or United Health. In fact, the top 10 holdings make up more than half of the ETF. On the other hand, VHT, the Vanguard Healthcare ETF, also focuses on healthcare, but it's much bigger. It holds around 400 companies across large, mid, and small cap healthcare firms. Moreover, the top 10 holdings represents the 44% of the ETF. So even though both ETFs are healthcare ETFs, their diversification is very different. XLV is concentrated in large companies, which increases risk if a few underperform, while VHT has broad exposure across large, mid, and small companies, making it much less concentrated. I'm not saying one is better than the other, just pointing out these are things you should consider before choosing which one to buy. Mistake number 2, thinking ETFs are risk-free. This mistake is different from mistake number 1 because it's not about diversification. It's about overall market risk. Even broad ETFs, like those tracking the S&P 500 or the total stock market, can lose a significant portion of their value during a market crash. For example, during the 2008 financial crisis, the S&P 500 lost around 50% of its value. And yes, even in smaller downturns, it's common to see 20 to 30% drops. The problem is that many investors see ETFs and think, "Oh, this is diversified, so it must be safe. I can't lose that much." That mindset can be dangerous. When markets drop sharply, these investors often panic and sell, locking in losses that could have been avoided by staying invested. The truth is, ETFs are safer than individual stocks because they spread your risk across many companies, but they still carry market risk. If you are not prepared to be in the market, there are much safer assets out there, like bonds or savings accounts. However, the expected returns would be potentially much lower. Mistake number 3, ignoring fees and commissions. Even though ETFs are generally low cost compared to mutual funds, there are 2 main types of fees to watch out for. Expense ratio. This is the annual fee the ETF charges to manage your money. Expense ratios often depend on the type of management. Passive ETFs, which track an index, usually have very low fees. Actively managed ETFs, where managers pick and choose stocks, tend to have higher fees to cover research and management costs, usually above 1%. On the other hand, you also have to keep in mind brokerage commissions or transaction costs. Buying and selling ETFs may include trading fees depending on your platform. And here's an important point. Commissions and fees are closely connected to our next mistake, ignoring tracking error. Tracking error is especially important for passive ETFs, the ones that are supposed to simply follow an index. After all, if you're paying for an ETF to track the S&P 500, you expect it to match the index as closely as possible. Even if an ETF seems low cost and well managed, it may not perfectly follow its benchmark. And that difference is called tracking error. A small tracking error isn't a huge issue, but a large tracking error means you could earn less than the index, even if you thought you were investing in the same market. It can happen due to many reasons: management fees and fund costs, delays in rebalancing holdings, or liquidity issues with some stocks in the index. So, you should always look for a lower tracking error, which means the ETF does a better job of following its index. Mistake number 5. Focusing too much on past performance. One of the most common mistakes investors make is choosing ETFs just because they did well last year or over the past few years. It's easy to look at a chart showing a 20%, 30%, or even 50% return and think, this ETF is a winner, I need to buy it now. But here's the truth: past performance does not guarantee future results. Markets change, and what was hot last year might underperform the next. Instead of chasing past returns, focus on the ETF strategy, holdings, diversification, and fees. Make sure it aligns with your long-term investment goals rather than last year's performance. Mistake number 6. Trying to time the market or lacking a clear strategy. Many investors make the mistake of trying to buy low and sell high, or waiting for the perfect moment to enter the market. The problem? Timing the market almost never works, even for professional investors. Without a clear plan, it's easy to hesitate and miss opportunities when the market is rising, buy impulsively after a big gain, risking a downturn soon after, or panic and sell during market drops, locking in losses. I am sure you've heard the famous quote, "Time in the market beats timing the market." I couldn't agree more. Historical data shows that missing just the 10 best days of the S&P 500 over the last 20 years can cut your total returns by almost half. That's why staying invested, even during volatility, is usually far more effective than trying to predict the perfect entry or exit points. Instead of timing the market, focus on having a clear, long-term investment strategy. Decide how much you want to invest, stick to it consistently, and consider methods like dollar-cost averaging, especially for passive investing. Mistake number 7. Investing in leveraged ETFs without understanding the risks. Leveraged ETFs are designed to amplify the returns of an underlying index, often 2 times or 3 times. Although it might sound tempting, here's something to be aware of. Now take a look at this graph. The blue line shows a regular index ETF, and the orange line shows a 2 times leveraged ETF, which is designed to move twice as much as the index each day. If the index goes up, the leveraged ETF should go up even more. But here's the catch. The leverage resets daily, and that matters a lot when the market moves up and down. Every time the index goes up, the leveraged ETF goes up twice as much. But when the index goes down, the leveraged ETF also goes down twice as much. And because these gains and losses compound on different starting values each day, the leveraged ETF loses more on the down days than it gains back on the up days. So even though the index ends up roughly flat, the 2 times leveraged ETF ends up much lower. In my humble opinion, I think leveraged ETFs are not suitable for long-term investors, and even less so for beginners. And there you have it. 7 ETF mistakes that could silently be eating your returns. As always, I'd love to hear your thoughts and feedback in the comments below. It always gives me great ideas for future videos. If you enjoyed this video, don't forget to like and subscribe for more. Thanks so much for watching, and I'll see you in the next one. Bye.